Hey, my name is Tucker Kraus and welcome back to my channel, and in today's video I'm going to be doing just a overall market valuation update, not just uranium but the S&P 500 or just, the US market in general. First, I just want to quickly look at the CPI. We just got the April numbers on May the 11th, and so we can see that while the April numbers were a little bit lower than the March numbers, the numbers were still higher than expectations. So, of course, inflation is still very hot, though, this could possibly point to us seeing a peak in inflation and it remaining elevated for some time or coming back down to a more regular rate. I personally think it's still going to be elevated for quite some time, if not continue to rise, but, I'm just me, and everyone's going to have a different opinion on that, depending on the research they've done. And so on this, the markets did initially rally before they continued to dump like they have been for the past couple months. So of course, if inflation continues to stay high, that's of course, not going to be good for the overall economy and the markets. Alright, to look here at the Shiller PE ratio, it would still point to the market being overvalued. This is just on the S&P 500, I should note. And the Shiller PE ratio, if you're wondering, is the average inflation-adjusted earnings over the past 10 years. And so, of course, when we're at 30.98, we're still pointing to being quite overvalued due to the fact that the mean is 16.94 and the median is 15.87. And this goes back a very long time. Alright, so next up for valuations, we're going to be looking at the Buffett indicator. So this just takes the total value of the US stock market and compares it to GDP, and this goes back to 1950, so not quite as far back as the Shiller PE. Alright, so as we can see here, it still points us being 36% higher than the long-term trend line, so still fairly overvalued because we have a 179% ratio of market value to GDP, and of course you want it to be at 100%. You want the US stock market to be equal to GDP, according to the Buffett indicator. So, of course, once again, we can look here. We can see it gets quite high before dumping back down. Once it gets to this, red line, dumps back down quite a ways, and we see that once again here. It hit this red line and has started to dump down, and at least according to this indicator, it seems like we have still quite a ways to go. Alright, so onto the S&P 500 mean regression. So this kind of just points to okay, how out of whack is the S&P 500 getting compared to the long-term mean growth rate of the S&P 500? Once again, we can see here, you hit the red and you come crashing down. And once again, that's happened here, and it still looks like we have quite a ways to go because we're still well above that trend line. So all of these do point to the market still being quite overvalued, with inflation running hot and, the Fed pumping rates and the economy looking very weak in general. It definitely seems like the bottom is still way out on the general markets. But of course, the Fed could actually be like, nope, we're actually going to cut rates all the way back down to zero and start buying a whole lot of stuff. And, maybe that means we hit a bottom. Who knows? I'm not, educated enough to know exactly how this is going to go. I thought it was just interesting to look at some of these metrics that say, hey, the market's still fairly overvalued even with this dump. Either way, though, there's of course a lot more to it than this. Do your own research. Thanks for watching, and I will see you next time.